Warren Buffett started life in Omaha, Nebraska in 1930. He bought his first stock purchase at age 11. Went on to study securities at Columbia University under legendary finance guru Benjamin Graham, before founding the Buffett Partnership at age 25. He's now one of the world's richest people with a net worth of over $108 billion as of February 2023. Do you want to know how the Oracle of Omaha built such a massive fortune and the simple formula behind his undeniable success? Then stay tuned, as this video will explain the overarching strategy and the 6 simple principles professed by Warren Buffett that you can adopt into your own investing plans. If you hang around until the end, we'll give you insight into the top 5 stocks that Warren Buffett has owned for the longest, and which have been the most profitable for him. So what is this elusive strategy that has made Warren Buffett super rich? The answer is value investing. Value investing means finding high-quality companies at fair market valuations and holding them indefinitely. The aim is to pay prices for investments that are low relative to their intrinsic values. Warren Buffett is a genuine value investor, acquiring shares in underpriced but strong corporations and holding them for the long term. In fact, one of his most memorable quotes aimed at day traders trying to get rich quick was, "If you're not prepared to hold a stock for 10 years, you shouldn't hold it for 10 minutes. By holding for the long term, the magic of compounding takes over. Compounding is the process whereby interest is credited to an existing amount as well as to the interest already gained. Compounding can therefore be translated as interest on interest, which leads to magnified returns over time." Okay, so all this sounds simple enough, but just how do you put this into practice? Principle 1. Safety margin. Giving precedence to a margin of safety is one of the key foundations of Buffett's investment system. For a margin of safety to exist, the investment should have attributes that help to minimize losses for investors. If the shares of the company are trading at $5 each, yet the assets of the business are actually worth $10 per share, then there's an expected safety margin of $5. The underlying worth of the assets should therefore minimize any fall in the company's stock price. In one of his letters to partners, Buffett once wrote, "This is the cornerstone of our investment philosophy. Never count on making a good sale. Have the purchase price be so attractive that even a mediocre sale gives good results." Principle 2. Avoid junk and target high quality. No matter how low priced a stock becomes, ordinarily Buffett won't invest if they are a struggling business. One of his best aphorisms is relevant: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Buffett picks stocks based on their total potential and holds these quality shares for the long term. So instead of looking for capital gain, he seeks companies highly qualified to achieve great earnings. Buffett's primary consideration for investing in a company is how well it can generate cash, rather than if the market will at some point realize its true worth. Principle 3. Find your own value and ignore the crowd. Warren Buffett has long espoused the importance of ignoring the crowd when investing. He believes that the market as a whole is often wrong, and that investors should instead focus on companies with good fundamentals and long-term potential. In his famous annual letter to shareholders, Buffett has said that investors shouldn't concern themselves with day-to-day fluctuations in the stock market, and should instead focus on the long-term performance of the stocks that they own. He believes in staying focused on the things that will drive a company's value over time, rather than trying to time the market. Principle 4. Market crashes and corrections shouldn't be feared. Warren Buffett has seen multiple market crashes and corrections in his long and illustrious career. He is well known for his words of wisdom and guidance on such matters. In one of his most famous quotes, he said, "Be fearful when others are greedy and greedy when others are fearful." He also believes in diversifying one's portfolio to mitigate the risk of large losses. Thus, Warren Buffett has sound advice for those looking to invest during market crashes and corrections. Look for opportunities in overlooked sectors and stocks, and diversify your portfolio to reduce the risk of large losses. Principle 5. Be patient and disciplined. As one of the world's most successful investors, Buffett often speaks about the importance of having a long-term mindset when it comes to investing. He believes that the best investments take time to develop, and that the rewards of doing so are far greater than any short-term returns. He often says that it takes 20 years to build a reputation and 5 minutes to ruin it, which is why he emphasizes the need to focus on long-term growth and stability. He recommends using a diversified portfolio to spread risk, and to invest in well-managed companies with solid long-term prospects. He also emphasizes the need for patience and discipline, as markets can be volatile and unpredictable. By staying focused on the long-term goals and making sure to invest with a steady hand, Warren Buffett believes that investors can create substantial wealth. Principle 6. Always have an exit strategy. The renowned investor has a few pieces of advice for when it comes to selling stocks. Firstly, he has said that investors should not be swayed by short-term fluctuations in the market and instead focus on long-term goals. As such, he advises against selling stocks unless there is a fundamental change in the company's underlying business or the overall market environment. He has also advised that investors should always diversify their portfolios across different asset classes and sectors to reduce risk. Additionally, Buffett has argued that investors should always have an exit strategy when entering the market, and that they should sell when the market or their own personal returns become too risky or unsustainable. In one famous quote he said, "The most important thing to do if you find yourself in a hole is to stop digging." Now I promised as a special additional bonus for watching to the end I would share with you the top 5 stocks held by Warren Buffett, as of February 2023. Here is a look at the 5 stocks that Warren Buffett has owned for the longest and which have been the most profitable for him. Berkshire Hathaway is the largest holding for Warren Buffett. He purchased the stock in 1962 and has since seen it grow to become a massive conglomerate. His investment has paid off handsomely, with the stock up more than 1,800% since his initial purchase. Other long-term investments have included Coca-Cola, American Express, and Wells Fargo. All 3 of these stocks have seen massive returns since Buffett's initial purchase. Finally, IBM has been a long-term hold for Buffett and has seen returns of over 200% over the past 5 years. All of these stocks have been highly profitable for Buffett, making them great investments for anyone looking to benefit from the wisdom of one of the world's greatest investors. Thanks for watching, and if you like this video hit the subscribe button to let us know.